In this video, we're going to discuss the final chapters, I guess, if you will, of financial distress with respect to financing the company. So obviously, financial distress is a well-known definition. It's basically when companies have challenges meeting their debt obligations. If you can't make the interest payments, default can be issued as judgment against you, and then you have to take action. At the end, in the worst of all cases, you may ultimately be forced into bankruptcy. Now, equity financing, right, issuing stock, doesn't have the bankruptcy connotation with it. However, in the end, the shareholders are obviously impacted if the company were to enter into bankruptcy. So we're going to go through some examples throughout this video, try to make the point of what happens when companies finance and how financial distress can ultimately impact the value of the company. So we have this company, Armin, they're going to do a project, right? If this project's a good project, it'll be worth 150. If it fails, then the company is only going to be worth 80 million. So there's two alternative structures that we can choose. We can choose all equity, or we can choose debt that matures at the end of the year, and at the end of the year it will have a total value of $100 million due. So if this product is successful, the company will be worth 150 million. So if there's no leverage, right? If there's no debt, equity holders get the full benefit. However, with leverage, the company has to make these $100 million debt payment, and Armin's equity holders will get the remaining 50 million. So even if they don't have 100 million in cash available at the end of the year, it wouldn't be forced into default on this debt because they could sell shares to get the funding. So with perfect capital markets, as long as the value of the firm's assets exceed its liabilities, they'll be able to repay the loan. Again, that's what I just mentioned on the last page. If a company has access to capital markets, of course, it can issue new stocks at a fair price, and then it need not default as long as the market value of the assets exceeds its liabilities. So again, as long as there is more assets than liabilities, the company will be able to pay off the debt that it owes at the end of this year. Now, if the product fails, the company's only worth 80 million. So without leverage, the equity holders are going to lose $20 million because the company was worth 100 million. With leverage, we're going to experience some financial distress and the firm's going to default. So in bankruptcy, debt holders receive ownership of the firm's assets, leaving its shareholders with nothing. Because the assets the debt holders receive have a value of 80 million, again, they're also going to suffer a loss of 20 million. So both debt and equity holders are worse off if the product fails rather than succeeds. Without leverage, if the product fails, they lose 70 million. That's 150 million minus the 80 million ending value, or 70 million. But with leverage, equity holders lose 50 million. And the debt holders lose 20 million. But the total loss is the same. It's still 70 million. But in this instance, what we see is that the shareholders ultimately are going to share the losses with the creditors. And I think it makes a little bit of sense. If you can move losses to somebody else, that might be a good idea if you could. So Again, without leverage, the success, you get 50 million. Failure, you get 80 million. Again, what does the company look like with leverage? Again, it is split out. Again, at failure, we see that the shareholders in the end have nothing. So here's the 20 million in loss that they ultimately would see for the debt holders. So let's kind of review a little bit here, right? If this new product fails, the investors are equally unhappy whether the company has debt and declares bankruptcy or whether it's unlevered and the share price declines. Now, this decline in value is not caused by bankruptcy. The decline is the same whether or not the company has leverage. So if the definition of what we're seeing here is not bankruptcy issues, it is economic distress, which is a significant decline in the value of the firm's assets, whether or not it experiences financial distress due to leverage. So let's think a little bit about bankruptcy and capital structure then to try to pull this together. With perfect capital markets, Mediglia and Miller, their Proposition 1 applies. The total value of all investors doesn't depend on capital structure. So there's no disadvantage to debt financing, and a company is going to have the same total value and will be able to raise the same amount initially from investors, regardless of their choices of capital structure. So let's take another example and look at another problem. Suppose the risk-free rate is 5%, and the new product is equally likely to succeed or fail. So we're going to suppose that the cash flows are unrelated to the state of the economy, so that the project has a beta of 0, and the cost of capital is the risk-free rate. So now we want to compute the value of the securities at the beginning of the year with and without leverage. And again, to show that the Modigliani and Miller Proposition 1 is ultimately going to hold. So if you look at the equity unlevered, V sub U, right, is half of 150 plus half of 80. This is the half of this is the calculation of ending value. And then we find the present value of that divided by 1 plus the return or the cost of capital. So the value of the company is 109.52. So with leverage, equity holders either receive $50 million or nothing, and debt holders receive $100 million or $80 million. So if you kind of think about this process, right, the value of the unlevered firm, right, is the value of the equity debt and the value of the equity that's levered and plus the value of the debt, right? The value of the entire company is the value of equity plus the value of debt. So again, if the equity is worth $50 or more, or 0, the present value of this is that $23.8 million. And for the debt, it's either 100 or 80. Again, that's 85.7 million is that present value. And if you add that together, we end up with the exact same values we had before if it was unlevered. So what we've been able to show is that regardless of how you split the company between debt and equity, the end value of the company is the same whether you have equity only or whether you actually borrow some money. As Modigliani and Miller proposed, the only thing that changes is who gets the money. How is the cash in the end, or the value of the company, how is it split between the two opposing sets of investors, if you will. So we're going to move on to the next video now.